At the end of August, inflation was 20.3% in Nigeria, 25% in Malawi, and over 30% in Ethiopia and Ghana. It was 8.3% in the US and 9.1% in the euro area. The impact of the rising inflation on Africa is devastating. The International Energy Agency estimates that by the end of the year, 30 million more Africans will be unable to afford fuel for cooking. The World Bank estimates that the number of Africans living in extreme poverty will increase from 424 million in 2019 to 463 million in 2022. The response to inflation has been for central banks around the world to raise rates. One central bank that everybody watches keenly is the U.S. Federal Reserve. Now, this week, the Federal Reserve announced another third consecutive jumbo interest hike of 0.75%. Central banks in Europe and Asia tightened their monetary policies following the U.S. Fed's decision. And where the U.S. goes, the world seems to follow. So what does this mean for the global economy and more specifically for Africa's economies? Joining me now is Victor Aluyi. He's the president. Joining me now is Victor Aluyi. He is the Senior Vice President and Head Investments, Sankore Global Investments. Victor, welcome back to Business Edge. Thank you for joining me.
Thanks for having me.
So it's important that we continue to try to establish why, but even though there's a number of disagreements, and I'm going to ask you again, I know we've talked about this, but as we continue to see the numbers come out, maybe it's making it clear as to why we are where we are. Some say it's primarily a supply side problem because of the dislocation of supply chains from COVID pandemic and then the war in Ukraine. And others say it's because of the loosening monetary policies of leading central banks like the Fed, which actually kept interest rates low and engaged in quantitative easing for a number of years. Where do you stand on the why of where we are where we are?
I think it's a combination of all of that, really. It's not one-sided. So clearly, in the aftermath of COVID, you had unprecedented, not just monetary, but also fiscal stimulus. The idea was essentially to try and support the economy, particularly in the West and even globally, just to create a situation where the demand destruction is sort of lifted and, the economy is reflated. So we had, and coming into COVID, we'd had, ultra loose, monetary policy. Interest rates had been at zero really for a broad variety of, central banks globally. If you look at the ECB, interest rates had been negative for the better part of the last decade. The same thing went for the Bank of England, the same thing, the Swiss National Bank. The Fed basically had interest rates just slightly above zero going into COVID. So immediately COVID hit, part of the immediate response was to significantly reduce, those interest rates to create a very, accommodative monetary policy posture or situation that would ensure that, demand receives great support. So not just on the monetary side, we also had fiscal support. I mean, in the United States, for instance, you had those stimulus checks that went out to individuals, So it's been a combination of unprecedented fiscal and monetary stimulus. Also in the U.S., I mean, it's the Federal Reserve was buying 95 billion worth of treasuries on a monthly basis, basically pumping 95 billion into the system every month, plus all of the fiscal stimulus as well. If you then slap on top of that the supply chain disruptions that COVID created, the impact continues to reverberate with us today. All of that created a perfect cocktail for the decade high inflation that we're seeing today globally.
So the equation is supposed to be that when you increase key interest rates, you then see a discouragement of spending, which is supposed to help reduce inflation for the prices of goods and services. But there's typically a downside, and we're seeing that downside right now. We're also seeing that equation doesn't seem to be holding true right now. So, Victor, is the equation broken, would you say, or particularly for African economies, that downside, as we see central banks also follow this trend of raising interest rates, what is it?
I mean, the equation isn't broken. There's typically a lagged effect. Monetary policy doesn't take effect that quickly. There's a transmission mechanism and there is a lagged effect. So for instance, in the US, the Fed obviously has been raising rates quite aggressively over the last couple of months. We've, like you mentioned, we've seen the third consecutive 75 basis points hike that has taken, the Fed funds rates to a range of 3.25 3% to 3.25%, which is pretty much like the highest that we've seen in quite a while. If you look across board, really, the BOE also raised interest rates this week by 50 basis points. The Swiss National Bank did the same thing. The Swedish National Bank did the same thing. The ECB did the same thing earlier on in the month. And we are coming off a decade of negative interest rates and moving into a situation where interest rates now have become positive. The idea is to try and slow down economic growth. By extension, you will slow down demand and then slow down inflation. That's the idea. The truth of the matter is that, the fact that, this inflation has been caused not just by demand side issues, but also supply side issues. What monetary authorities would do is try and take care of the areas they have control over. And they certainly have control over the, demand side of the equation. And that's what they're basically trying to do.
All right, so we've seen the body language and as well as the statements from members of the Federal Reserve. The chair, Jerome Powell, he has stressed that he is resolved to continue to lift rates high enough to drive inflation back towards the central bank's 2%. And it seems many have said that he's not afraid of taking the U.S. into recession. But while the U.S. may not be afraid of going into recession, what happens to the rest of the world, particularly African economies? What would another global recession mean for our continent?
I think we'll probably start at the early stage of maybe feeling the pinch as it is. So we're going into a period of increased interest rates across board globally. That situation is going to create some fiscal stress. We've also seen the dollar strengthen quite significantly this year, just on the back of what the Federal Reserve is doing. And not just for emerging markets. We've seen the pound slump to, a 37-year low against the dollar. We've seen the euro move to parity. We've seen the yen at a 24-year low against the dollar. We've seen the yuan, that's the renminbi, cross the 7 mark, which is, a threshold. So essentially, the dollar is significantly strengthening. So for countries that are still very import dependent, it's going to be a very, very challenging situation. Also, from a fiscal standpoint, it just simply means that it's just going to be a bit more expensive to borrow, not just in the international market, but also in the local market. So it's going to create, currency challenges. It's going to create fiscal issues that countries, need to deal with. And one of the key ways that countries are trying to deal with this is also by raising interest rates across board. So these are the challenges that we face, and I think will be with us over the next, 18 to 24 months.
All right. So you mentioned the number of banks that follow the U.S. Federal Reserve and also raising rates. We are expecting on the continent, the central banks of Nigeria, South Africa, and Egypt, which are the continent's 3 biggest economies, should also raise interest rates in the coming days. They are among 6 which are likely to tighten monetary policy, and another 6 countries look set to sort of pause to assess the impact of their previous hikes and even relief measures. In terms of the continent now, how much should we be expecting, particularly from Nigeria, South Africa, and Egypt, which might also lead the way on the continent?
Well, I think so. For Nigeria, for instance, given the level of inflation that we're seeing, the kind of price instability that we're also seeing, particularly on the FX front, we should see some symbolic increase in rates. But I think suffice it to say that the transmission mechanism here doesn't quite work as smoothly as it does in the developed world. Again, because these inflation issues are not necessarily only demand side issues. You also have the supply side issues that have been with us, in Africa for quite a while, so all of that needs to be dealt with and fixed. And that's a much more longer term type solution. However, I think in the interim, the way to go would really be to increase those interest rates and try to, sort out, the demand side of the equation and ensure that, prices stabilize over the near to medium term.
All right, Victor, before I let you go, we've heard from the World Bank, which has advised many countries to not actually hike interest rates, rather to go the way of job creation and also ease movement, particularly of goods and services. Is raising interest rates the only economic tool, the only sort of monetary tool available right now? And you said we're going to be stuck with it for the next 18 to 24 months. Is it the only option available, particularly for African economies to utilize as we look to fight global inflation?
So the big issue, like you said, inflation really is the key risk right now. And you've got to tackle it head on. And in trying to tackle inflation, really, the major tool that monetary authorities have got in their toolbox is interest rates. And, on the fiscal side, there's a lot that obviously needs to be done to take care of the infrastructure issues that we have that will certainly heal the supply side of the inflation equation. However, the demand side is where monetary authorities have control, and the basic tool that they have is interest rates. So globally, inflation is a big threat. So monetary authorities will certainly deploy the tool of interest rates to try and take care of inflation. It isn't the only tool. It isn't the only thing that they can do, but to try and get this situation under control as quickly as possible to ensure that we don't necessarily get deeper into a cost of living crisis, to ensure that price stability does not get eroded over a sustainable period. They have to raise interest rates for now.
I actually lied. I have one final question, and I'll need you to answer this in 1 or 2 sentences. How close do you think we are to a recession right now?
I think globally, we are certainly at the beginning of a significant slowdown. Whether or not we then get into a recession really is another question. How deep, how long it lasts, jury's out on that, but we're certainly going to slow down globally.
All right, Victor Aluyi, thank you so much for joining me. We'll keep our eyes on the developments and the numbers, and we'll look for you to break them down and explain it for us. Thank you so much.
Thanks for having me.
Yeah. All right. And it just re-echoes what one of my guests earlier this week had said. Maybe it means the numbers now need to catch up with reality, and many across the continent are feeling a recession in their lifestyles, in their pockets, and in their economies already. You're watching Business Edge. We'll be wrapping things up now with NC4 to watch. Stick around. And now to a few stories we're tracking to see how they play out throughout the course of today. We start with Nigeria, where the African Development Bank president, Dr. Akinwumi Adesina, says the country needs help in tackling its debt burden. According to Adesina, financing is critical to solving Nigeria's development challenges. The country's total debt level is 42.84 trillion naira, or $103 billion. External debt levels stand at around 16.61 trillion naira, or around $40 billion. The Central Bank of Egypt has left its overnight interest rates unchanged, saying it believed inflation was under control over the medium term. The bank raised the reserve ratio to 18% from 14%, saying that this would help tighten liquidity. In a statement, the bank's Monetary Policy Committee said it kept the deposit rate at 11.25% and lending at 12.25%. Oil headed for a 4th weekly decline after a raft of interest rate hikes around the world darkened the outlook for energy demand. WTI futures edged about $83 a barrel, with prices down more than 2% from the week. And Brent for November settlement also declined 0.6% to $89.92 a barrel on the ICE Futures Europe exchange. And finally, gold steadied after a volatile session as a parade of central banks followed the Federal Reserve in raising interest rates to cool inflation. It swung between gains and lows, dropping as much as 1.1% after Japan intervened in the foreign exchange market to strengthen its currency, causing bond yields to climb and the dollar to slide before later recovering. Gold is trading near a 2-year low and could enter a bear market with the dollar at record levels. And that wraps things up on Business Edge for this week. Thank you so much for joining us. If you've missed any of our conversations that put the African economy, finance, and business front and center, you can download our mobile app to find them or head to our YouTube channel to check out what you may have missed. Follow us on social media. We are at New Central TV, and watch us DSTV channel 422, Star Times channel 274, Avo TV, and a number of other platforms. Until Monday, when I come your way, 11 a.m. West African time, I'm Tolulope Adeleru-Balogun. Do have a fantastic weekend.